Hey guys, it's Marco. So the other day I was taking a look at my investment portfolio and figured it might be a good time to introduce you guys to the stock market. So without further ado, here's a beginner's guide to the stock market. First things first, what even are stocks? Stocks are small portions or shares of a company. So owning a single share in a company means you own a very, very small fraction of that company. So if the company makes a profit, you might be entitled to a tiny part of that profit. Or if the company grows in value, then the value of your stocks can grow as well. You can buy shares in many of the companies that you might use or hear about on an everyday basis, such as Netflix, Amazon, Facebook, and thousands of others. These stocks can be bought and sold on what's known as the stock exchange or the stock market, which you can easily access from your computer or phone. So owning a teeny tiny part of a company you like might sound cool, but what's really the point? Well, stocks can be an amazing way to build wealth and supercharge your ability to save and make money. For example, let's say you wanted $1 million. Maybe you want to use it to help you retire, or buy a business, or your dream home. Whatever it is, I don't think very many people would say no to $1 million. So, let's say you manage to save $1,000 every single month without fail. At that rate, it would only take you 83 years and 4 months to save up $1 million. So even if you started at the age of 20, you still wouldn't get there before the age of 100. That's not ideal. Now, let's instead say that you took that $1,000 a month and invested it in the stock market. On average, the stock market gives an annual return on investment of about 9%. This means if you bought $100 worth of stocks, in a year's time, they'd be worth about $109. This might not seem very significant, but these returns build on top of each other so that your money keeps growing faster and faster. That same $1,000 a month, making 9% in the stock market, would take less than 25 years to turn into $1 million, almost 6 decades faster than trying to save up without investing. This is because that yearly growth is doing most of the work. And by the time you reach $1 million, you would have only put in about $298,000 of your own money. And even though you kept investing $1,000 every single month, in the final year, your portfolio was growing by almost $7,000 a month purely on its own. If you kept going even longer, imagine how much money you'd have after 30, 40, or 50 years. The more time you let your investments grow, the more that interest can compound on top of itself. If you're anything like me, you might be thinking you should probably start investing as soon as you possibly can, today even. But before you invest any money at all, there are a couple of financial foundations that you need to lay first. If you don't care about these and you just want to hear about the stock market, feel free to skip to this part of the video. First, if you have any high interest debt, you should focus on paying that off first. High interest to me usually means anything more than about 4 or 5%. So this usually includes things like credit cards, personal loans, and potentially car or student loans if those are costing you more than 5% interest every year. Why should you pay these off? Quite simply, if you're investing money in the stock market trying to make 9 or 10% per year, but you're paying credit card debt that's costing you 20% in interest, then you're going to be making much slower progress. Using any spare money you have to pay off credit card debt at 20% interest means you're getting a guaranteed 20% return on your money, which is better than you would have gotten in the stock market for most years. Once the card is paid off entirely, you also then have more money left over at the end of each month to attack other debts or to move on to the next step if you've already taken care of your high interest debts. If you've got debt that's costing you something like 6% in interest, maybe something like a car loan or a student loan, you might be thinking that average stock market returns are slightly higher than that, so it would be better to invest. However, you have to remember that it's better to save money than to make the same amount of money, because you have to pay tax on the money that you make. Additionally, there is also something to be said for guaranteed returns. While long-term gains in the stock market have some consistency, returns in any given year could vary drastically, from just a few percent to over 40%, or you could even lose money some years. However, if you use the money that you would have invested to pay off debt, at least you know exactly what your returns are going to be, for better or for worse, and you can make plans around exact numbers. Basically, it's about reducing risk. So even though it may take years, try to focus on paying off high interest debt first before you invest anything in the stock market. While you're doing that, keep educating yourself and learning as much as you can about finance and investing so that when you finally are ready to invest, you'll be as confident as you can be. Once you've managed to pay off all your high interest debt, or if you didn't have any to begin with, you can move on to the next step, the emergency fund. An emergency fund is a savings account that you only use in emergencies so that you don't have to go into high interest debt to survive. These emergencies might include things like suddenly needing to book a last-minute flight to go see a sick relative, your car needing emergency repairs if you need your car to continue working, or even unexpectedly losing your job. You can use an emergency fund to cover these unexpected expenses or to replace your income for a while until you can find another job. It's usually recommended you try to save up between 3 and 6 months of expenses, depending on how secure your income is, how much risk you're willing to accept, and some other factors. For most people, 3 months of expenses is probably going to be enough. The reason it's important to have an emergency fund before you start investing is so that you don't have to sell off any of your investments if something unexpected comes up. If you lose your job at the same time that the stock market isn't doing very well, such as in a recession, the last thing you want to be forced to do is to sell your investments at a loss just to make ends meet. Once again, this is about reducing risk so that you can be more confident in your investments without having to constantly worry about something unexpected happening. As before, reaching this milestone can potentially take a long time, so don't worry if your progress is slow. As you're building up that emergency fund bit by bit, just know that you're laying a solid financial foundation upon which great things can be built. Now, when you finally paid off all of your high interest debt and you've built up that emergency fund, you can finally start investing with one last small caveat. Never invest money in the stock market that you know you're going to need in the next 3 to 5 years at least. This is because while the stock market trends upwards in the long term, in the short term it can be extremely volatile. In the past, the stock market has swung up or down by 10% in a single day, and in a single bad year in the market, you could lose 20 to 30% of your investment. If you're investing for the long term, such as 10 or 20 or even 30 years, this isn't necessarily a problem. When the market crashes, just don't panic. Don't sell your investments and just wait for the market to recover. However, if you have a hard deadline for when you need to pull the money out of the market, you might be forced to sell at the worst possible time and have less than you started with. So, any money that you know you're going to need in the next few years, maybe a deposit for a house or a new car, should stay out of the market. Anything that you might have left over after that, feel free to invest. So now that you're ready to invest, how do you actually make money in the market? Returns on stocks come in two main forms: capital gains and dividend income. Capital gains refers to the value of stocks going up. If you buy a stock for $10 and a few years later you manage to sell it for $15, you've made $5 in capital gains. You might be wondering, who decides how much particular shares are worth? And the answer is, everyone does. Stocks are worth whatever people are willing to buy and sell them for. So every time there's a successful sale where the buyer and seller agreed on a price, that price becomes the new listed value of the stock until there's another sale at a different price. This means for high volume stocks, or stocks that are traded very frequently, the price might change multiple times per second. The second way you can make money with stocks is with dividend income. Dividends are a small portion of a company's profits that some companies might pay out to everyone who holds a share in their company. Keep in mind that not all stocks pay dividends, but you can see how much they pay by looking at their dividend yield, which is the total amount paid out in the form of dividends over the course of a year, as a percentage of the total value of the stock. So for example, if you buy a stock worth $100 with a 4% dividend yield, you can expect to get paid out about $4 in dividends over the course of the year. If you live in Australia or trade shares on the Australian Stock Exchange, there's one other factor that affects your income, and that is franking credits. Franking credits are a little bit complicated and deserve their own video, but for now just know that they represent a tax credit, or money that is paid back to you when you lodge your tax return. They are shown as a percentage of the dividend that is franked. So dividends that are 100% franked are going to let you get back more money from your tax return than dividends that are 50% franked. Now that you know how money is made on the stock market, what sort of strategies can you use? There are a few main categories of investment strategies, including value investing, growth investing, dividend investing, and day trading. Firstly, the aim in value investing is to find and buy shares that are trading at or below their true value, and then later sell them when they've risen to a fair or above fair value. This usually takes quite a lot of work to accurately value a stock and figure out if its current price is higher or lower than it should be. This discrepancy is possible because, as I mentioned earlier, stocks are worth whatever people are willing to pay for them, and people don't always do enough research to figure out what they should be paying. Occasionally, there'll be stocks that people are paying too little for, either because investors haven't yet taken into account some important factor that makes the business worth more than it currently is, such as landing some new contracts, or because investors are pessimistic about the market in general, even though a particular business might not be suffering, such as in a recession. These types of cases are especially prevalent in huge market downturns, such as the one that happened last year. So this is usually a great time to reevaluate stocks and buy ones that are undervalued. Growth investors, on the other hand, don't necessarily mind buying stocks that are overvalued, as long as they have the potential to grow even further. Growth investment is all about looking for companies that might grow drastically over the next few years or decades, often startups that aren't even profitable yet. Sometimes these stocks might already be overvalued, but if you have strong reasons to expect that a company might double, triple, or even quadruple in value, then paying 20% more than a stock is really worth might still be a good deal. Companies that are intensely focused on growth usually won't pay dividends, so the only way to make money with these companies is to sell the stock again at some point. Dividend investing, or income investing, is all about buying stocks that consistently pay out dividends. Dividend investors look for stocks with decent or above average dividend yields, but the year-on-year consistency of dividends might also be an important factor, and some dividend investors might look for stocks that pay very frequently. Dividends might be paid once a year, twice a year, once a quarter, or some stocks might even pay monthly, although this is not extremely common. Dividend investing can be a good option for people that want to retire off their income from the stock market, because you never need to sell any of your investments to generate cash flow. If you have enough invested, you can live off those dividends indefinitely without ever having to eat into your principal amount. Lastly, the black sheep of the investment strategy family, day trading. Day traders don't care about dividends, growth potential, or the intrinsic value of a stock. Day traders mainly trade stocks with small market capitalizations, which means when you add up the total value of all the publicly traded shares of a company, it accounts for a relatively small amount, usually less than $1 or $2 billion. Small market cap stocks are generally more volatile than large market cap stocks because the purchase and sale of a relatively small number of shares can have a large impact on the value of the stock. This volatility means that the value of a stock might swing up or down by more than 50% in a single day. Day traders aim to buy and sell a stock multiple times within a single day, hoping to buy it when the stock is low, sell it again when it peaks, buy it when it drops back down again, and sell it again when it goes back up. This means that even if a stock ends up roughly where it was at the beginning of a day, a successful day trader can still make relatively large returns. If you want to get into day trading, here's a good rule of thumb. Don't. Almost every single day trader ends up losing a lot of money because accurately predicting market trends on such a small time frame is almost impossible, even though there are thousands of people that will try to convince you that they have some sort of secret formula that works every time. Day trading is not so much an investment strategy as high-frequency gambling, so if you intend to keep your money, stay away at all costs. So, to recap, before you invest, make sure you've paid off any high-interest debt and that you have a solid emergency fund. Then, only invest money that you aren't going to need in the next couple of years. The sooner you can start investing in the stock market, the more time you'll have for your money to grow, so start investing as soon as you can. The stock market is volatile, and sometimes it crashes dramatically. In these cases, it's important to remember not to panic and not to sell off all of your investments just because you're panicking. You can make money in the stock market by buying stocks that are undervalued, stocks that have the potential to grow a lot, or stocks that pay decent dividends. Most people use a combination of these to build a portfolio that works for them. Whatever you do, don't get sucked into day trading. You'll almost certainly lose money, or even worse, you'll get lucky and actually make some good money, which will make you think you know what you're doing, so you'll start trading all of the money you have and lose almost everything. Lastly, I just want to mention that buying and selling stocks is just the beginning. There's a whole secondary and tertiary market of investment options derived from the stock market, such as short sales, options, and CFDs that are far more complicated. If you start researching and educating yourself on the stock market, you might come across some of these derivative products, especially in the form of targeted ads. If you're just a beginner, it's important to realize that these are risky investments that take a lot of knowledge, experience, and detailed research to use successfully, and that in some cases, you can lose a lot more money than you put into them. So at least for now, maybe focus on educating yourself on the stock market and stick to more basic investments. Well, that's it for today. Feel free to subscribe for some more financial education and like the video to help out the YouTube algorithm. It really helps much more than you might realize. And I'll see you in the next video.